Hello, fellow compounders. Are you looking for a simple yet effective way to invest your money? Have you heard of the Bogleheads 3-fund portfolio? In this video, we'll learn about the 3-fund portfolio. We'll see how it has performed over the last 20 years, and we will review its advantages and disadvantages. And at the end of the video, I'll provide a list of the funds you could use to set one up. This video is for educational purposes only and should not be considered financial advice. I am not your financial advisor, and you are responsible for your own financial decisions. The Boglehead 3-fund portfolio is a popular investment strategy based on the principles of Jack Bogle, the founder of the Vanguard Group, the creator of the S&P 500 index fund, and he was an advocate of passive investing through index funds. Check out the book, The Bogleheads Guide to the 3-Fund Portfolio by Taylor Larimore. The portfolio is composed of, you guessed it, 3 funds. The funds are 3 low-cost, broad-based index funds, which are 1. A U.S. total stock market fund, 2. An international total stock market fund, and 3. A total U.S. bond market fund. By investing in these 3 funds, you can achieve broad diversification across different asset classes, geographies, and market sectors. This investment strategy is suitable for investors of all ages and risk profiles. It's a simple and elegant solution. The risk and returns are adjusted by changing the asset allocation among the 3 funds. I'll show you some of the different fund allocations and their risk rewards later in the video. Here's how you can build your own Boglehead 3-fund portfolio. Step 1. Choose your investment platform. This means the brokerage company that you'll be using to hold your investments. You can open an account with a brokerage firm like Vanguard, Fidelity, or Charles Schwab. These firms offer low-cost index mutual funds that are suitable for building the 3-fund portfolio. In addition, you can choose to use index ETFs, or exchange-traded funds, which are funds that trade like stocks. And if you go this route, you could use any broker. I would suggest brokers that allow fractional share trading, like Robinhood or M1 Finance. Step 2. Decide on your asset allocation. This means how will you distribute your money among the 3 funds. A typical 60-40 stock bond allocation for a 3-fund portfolio will look like this. 45% in a U.S. total stock market fund, 15% in an international stock market fund, and 40% in a total bond market fund. However, your asset allocation may vary based on your personal goals, risk tolerance, and time horizon. Step 3. Choose your funds. You'll want to select low-cost index funds that track the broadest possible market indices. You can choose funds from Vanguard, Fidelity, Schwab, and others. Let's say you decided to go with Vanguard as your platform, in which case, for the U.S. Total Stock Market Fund, we will be investing in the Vanguard Total Stock Market Index Fund, ticker VTSMX. And for the International Stock Market Fund, we will be investing in the Vanguard Total International Stock Index Fund, ticker symbol VGTSX. And for the Total Bond Market Fund, we will be using the Vanguard Total Bond Market Index Fund, ticker VVMFX. At the end of the video, I'll show you a list of mutual funds and ETFs you could use to build your 3-fund portfolio. Step 4. Rebalance your portfolio. Over time, your investments may drift away from your target allocation. You should periodically rebalance your portfolio to ensure that your asset allocation remains consistent with your targets. Step 5. Stay the course. The Boglehead 3-fund portfolio is a long-term investment strategy, and it's important to stay disciplined and avoid making emotional decisions during times of market volatility. I ran a simulation of the 3-fund portfolio with 3 different asset allocations using the website portfoliovisualizer.com to see how they have performed from 2002 until January 2023. Here are the parameters we used for the simulation. We started with an investment of $1,000 on December 31st, 2002, and added $50 each and every month ever since. We also reinvested all the dividends received. The portfolio was rebalanced once a year. We will use the Vanguard funds, which I suggested earlier, VTSMX for US stocks, VGTSX for international stocks, and VVTLX for bonds. Here are the 3 fund allocations. Portfolio number 1, 45% in US stocks, 15% in international stocks, and 40% in bonds, a classical 60-40. Portfolio number 2, 60% US stocks, 20% international stocks, and 20% bonds. It's an 80-20 stocks versus bonds. And portfolio number 3, 67.5% US stocks, 22.5% international stocks, and 10% bonds. That's a 90-10 stocks bonds allocation. Here are the results. On January 31st, 2023, portfolio number 1 is worth $31,092 with an annual rate of return of 6.56% and a money-weighted rate of return of 6.74%. Let me explain what the money-weighted rate of return is. This is the return on your money that you invested. This includes the $50 a month which you were contributing throughout the 20 years. This means that the dollar cost averaging that you did actually was in your benefit. The 6.65% is what you would have gotten if you had invested at the beginning of the 20 years and never put a single dollar more. So you didn't average in any new money. So in this case, 6.56%, the total return of the fund. 6.74% is what you received because you averaged in $50 per month. And this is annualized returns, by the way. Portfolio number 2 is worth $35,992 with an annual rate of return of 7.32% and a money-weighted return of 7.86%. And portfolio number 3 is worth $38,499 with an annual rate of return of 7.64% and a money-weighted rate of return of 8.37%. A significant difference between portfolio 1 and portfolio number 3. What's the catch? Obviously, if you look at returns, we would prefer portfolio number 3. Well, the catch is that you need to have nerves of steel. Let's look at the max drawdown column. Depending on your risk tolerance, you should decide your allocation to bonds versus stocks. Take, for example, portfolio number 3 with a max drawdown of 48%. This means that if you invested $100,000 in the portfolio, at some point in time, the value of your portfolio would be $52,000, a little more than half its original value. So if you can live with that and be able to continue to be disciplined and buy more every single month, then portfolio 3's allocation could work for you. If you want to have less of a drawdown, then just add more bonds. Look at portfolio number 1. The max drawdown was 32% versus the 48% of portfolio number 3. Let's review the advantages and the disadvantages of a 3-fund portfolio. Let's start with the advantages. The first advantage is diversification. By investing in 3 different funds, you're spreading your risk across different asset classes, different countries, and different market sectors. This can help you reduce your risk and provide more stable returns over the long term. The second advantage is simplicity. The 3-fund portfolio is easy to manage and rebalance. This makes it a great choice for investors who don't have a lot of time or expertise to manage their investments. And the third advantage is low fees. All 3 funds are low-cost index funds, which means that you're not paying high management fees to a fund manager. And the fourth advantage is historical performance. The stock market has historically provided positive returns over the long term. Holding a diversified mix of domestic and international stocks and U.S. bonds has provided investors good returns over time. I suggest reading the book Stocks for the Long Run. I think I have it here. Stocks for the Long Run by Professor Jeremy Siegel of the Wharton School. I recently saw him in Miami a couple of weeks ago at a dinner that he was giving a lecture on. The book basically makes the point that you should invest in stocks for the long run. On average, this asset class has beaten out every other asset class in the history of investments. Now, let's review some potential disadvantages that investors should know when considering the 3-fund portfolio. The first advantage is limited customization. The 3-fund portfolio is a one-size-fits-all approach, and it's not suitable for investors who may have unique financial goals or risk tolerance. The second disadvantage is exposure to market fluctuations. Because the 3-fund portfolio is invested in the stock market, investors will be exposed to the market's ups and downs, which can be difficult for some investors to handle. Remember the 48% drawdown that we had in the simulation? That was caused by the crash in 2008. So the third disadvantage is that there are no guarantees. Like in all investments, there is a risk of loss, and past performance does not guarantee future returns. And the fourth disadvantage is that the success of the 3-fund portfolio requires discipline. Investors must stick to the long-term investment plan and avoid making emotional decisions during times of high market volatility. Here's a list of funds you could use. They're listed by fund family, and you have their ticker symbol and their expense ratio in the parentheses beside. Go ahead and pause the video or take a picture to review them. Remember, if you invest in mutual funds, you should buy them directly from their respective platform brokers. Otherwise, you may be charged extra fees for accessing competitors' mutual funds. And if you decide to use ETFs, you can use any broker because they trade like stocks. So any broker can trade a stock for you. I personally prefer using ETFs. So there you have it. The 3-fund portfolio, a simple and effective way to invest over the long term.